Welcome back to Cymax FinTech Weekly Market Insights. This is part 3 where we look at the macro picture and how that's going to impact the markets and our lives obviously going forward. So straight into it. Inflation, I'm going to cover all of this. So let's start. Although economies are, seeing weaker inflation, it's still sticky. It's not dropping very fast at all. And, that leads to stagflation as far as I'm concerned, and then ultimately recession. Stagflation, where we're seeing inflation without growth. And that is, quite obvious, I would say, at the moment. Now, central banks seem to accept that, there is the potential for a recession, but it's going to give them the opportunity to regain control of inflation. Now, that will make demand drop below supply. And then, hopefully that's going to cause companies to finally lower prices, which will drag inflation lower. Now, it's going to take months to get to this magical 2% that they come up with. Where did this 2% come from? Well, actually, it come from New Zealand, but I'm going to leave you to Google it because I don't really want to sort of dwell on that area. But, it's interesting. You should have a look. Okay, now, as I'm going to make this point, it's going to take months at 0.17% inflation to achieve their target rate of 2% inflation. Now, even if they achieve that, even if inflation drops, central banks are going to be keen to see it hold there for between 3 and 6 months before they even consider changing policy. And to me, that's why I expect rates to remain at their peak, until this is accomplished. And I think you're going into 2024 for that. And, it's only going to be then, really, that central banks are going to consider rebooting the economy. But how are they going to do that? Because I'm not sure that they're going to be keen to really drop interest rates back to 0 or 1%. I believe it's more likely to be a controlled descent. It's just going to be in those maybe 25 basis point increments, just testing consumers as they go along. Now, it's not what we're used to, but perhaps we should get used to this. Just remember, zero rates are for a crisis, not just to help us out or anybody out. They are to help in a crisis, just to sort of start to boost the economy again. Seeing rates at 5% for me, just remember I'm old, so I've seen all of this and a lot more. I've seen rates at 20%. So trust me, 5% doesn't really mean that much to me. But to me, it's more practical, to be honest with you. Of course, if you're borrowing, then, you'll be upset that they're this high. If you're a saver, obviously you're going to hope that they'd go higher. Now, this bait of inflation, for me, has shocked central banks and governments, which again is why I think they're going to be more cautious. And of course, we should remember that the governments and central banks actually added to inflation with all that stimulus they did over COVID. Of course, most inflation's been driven by supply chain issues, though. And of course, central banks and governments, they have very little control over that. Now, it's going to be interesting if my expectations are right, and of course, how the markets will react, especially the stocks. For me, profit margins are at decade highs. But I expect that to start to change by the end of this year. Economics, macroeconomics, is it working, especially with central banks so active everywhere, just over everything and inflating everything as they did? For me, possibly overall the system's broken. You know, just look at the banking sector. You know, okay, they were isolated problems, but there was some mixed problems come out of them, and of course there could be more to come. Then you've got central banks holding on to excessively high balance sheets, most of which are losing money, you know, on those assets, you know, and you know when you think about it, you know they bought all of these treasuries at around, let's say, on an average of two and a bit percent. You know, when they're pushing the market against themselves because they're the ones that's hiking the rates and pushing the markets up to 5%. So you know they've only got themselves to blame to a degree there, but you know they're pushing those bond yields up to levels that haven't been seen for really some time. Now, also in the US, Biden, you know, he's set to announce a new mortgage program. Uh, this is what I've been reading anyway, and this is going to be where they're effectively going to offer a discounted rate to those with poor credit. Work this one out, and then for those that have got good credit, they're actually going to charge them more. So you know, how does that work? It just doesn't make sense. Uh, well, what can I say? Anyway, you know, in time, again, you know, you've got to be careful about that because it could lead to yet another MBS crisis, you know, those mortgage-backed securities. So just watch for that. And of course, Biden's also come out and he's now intending to restrict companies, US companies that is, and the amount that they can invest into China. You know, to me, okay, all this protectionism and all that, but common sense just seems to have disappeared. You know, especially when you look at all these balance sheets and all these massive debt and all that. I mean, the US, you know, is trying to build theirs up from $31.4 trillion and make it go even bigger. You know, the Fed had almost 9 trillion on their balance sheet at one stage, and they still haven't got rid of much of that so far. You know, maybe it's time we actually brought back the gold standard. You know, borrow what you own, sort of thing, what you got assets for, rather than just being able to magic all this money out of thin air with just a keystroke, really. So stocks continue to have big moves, especially the Nasdaq. But I must admit, you know, I've really enjoyed that over the last few weeks. I'm not a massive trader of Nasdaq, but it's just been too good to resist. And you know, so for me, it's been ranging, but it's been a big range, so it's been really good. And of course, the dollar seems to sort of be consolidating, and the next move could be decided on Friday's data when we get that Fed favoured PCE released. If we look at oil, OPEC must be really disappointed. I suppose they would argue, well, they've stopped it from going lower. But, you know, okay, that recent surprise cut that they did, over 1 million barrels a day, you know, what did it cause in the way of a rally? Okay, it took it from 75 up to 81, dipped back down a little bit. You know, it made it into the 83s. But last week, you know, it was actually trading back down in the 76s before there was a late rally on Friday, and it got back to touch sort of $78. But you know, it's not really gone anywhere. And it seems now probably as if it's got back into that 72, 82 range for the moment. Gold's been struggling to maintain its rally above 2000. You know, it looked really strong, but it just couldn't sustain that. However, you know, something to remember here is that, you know, when you look at all these rate increases and all that, you've got to remember gold doesn't pay any interest. So it's something to think about. Commodities in general are looking a bit weaker. Something to bear in mind here, though, is that Russia's sort of refused to renew this agreement, this Black Sea corridor, so that could potentially close on the 18th, which could impact grains and also fertilizer. Now, as I mentioned before, keep an eye on jobless claims. They are increasing, and I expect this to continue. I expect there to be less jobs on offer, and I expect to see the unemployment data, you know, that those levels start to increase over time. You know, I don't think it's going to be massive, but it's just going to continue to grow and grow. So you're not really going to notice it because it's just going to be slowly building. But, you know, just keep an eye on it, because I think that that's going to give you a little bit more insight into what's going on. Now, in the UK, another senior politician bit the dust. The deputy PM resigned. And of course, so much for our wonderful PM's judgment. You know, it was supposed to be one of the qualities he was praised for. You know, that's after all of the backstabbing that there's been in the Tory party to actually get him in office in the first place. So time will tell there. You know, I'm in the UK, but I'm just not a fan of having practically a billionaire run the country. Okay, let's take another look at France. So Macron remains under pressure from his pension reform. There's been demonstrations. You know, some rioters even managed to storm the Euronext exchange and get into reception there. But strikes seem set to continue, and you know, growth over the next couple of years is not going to be great for France, I would say. I would expect below 1%. Now, another interesting geopolitical element is going to be Japan. So Ueda's first meeting as governor of the Bank of Japan, and you've got to watch it closely and just listen to what's said there. You know, inflation is at the highest level since 1981. And although he may not just instantly change policy, I've got a feeling he's not going to have a choice for much longer. And I think he's going to have to lift rates. You know, they're practically the only country left with negative rates. Now, they may not do it straight away, but for me, again, just remember this is just me, I expect it by the summer. Economically, you know, when we look at data, it seems services are performing well and definitely much, much better than manufacturing. Now, you know, whether that's because there's a lot of inventory being held at the moment because of all the supply chain issues we've seen in the past, or whether it is actually the start of demand dropping. But, you know, either way, it should tempt a drop in prices, which again will help reduce inflation eventually. You know, and again, you know, when we're looking at inflation, well, first of all, I just think that food is, you know, the ridiculous one. We as consumers are just being really taken advantage of. You know, when you look at it, I mean, world trade has shrunk by 5%. Most of the supply chain issues and protectionism that's there, it's still there. But, you know, China and Asian countries in general have seen a drop in global demand. And of course, supply chains, they are improving. However, you know, if that demand continues to drop, you know, is it rate hikes that's causing consumers to perhaps spend less, or is it the prices themselves? For me, I would say it's the prices themselves. You know, when you go into the shops, you know, not everything, of course. You know, don't really sort of look at prices that much, but some things you can't help but look and go, wow, I remember that being much less last year. Or, you know, if I'm sent out to do the shopping, I just think, what did I buy extra this time? But you know, you know, obviously it is impacting households, and it's not just low income. I would say it's middle income earners as well that, you know, are having to be a little bit more cautious with their spending. You know, you got rents up, food up. You know, it's a blessing really that, you know, the markets didn't react and get back to $100 a barrel for oil, and it's drifting lower again. But perhaps part of that is the fact that, you know, we are expecting consumer demand to continue to drop. Now, you know, we're seeing that costs have dropped down. You know, okay, in some areas, maybe not back to pre-COVID or war levels, but, you know, they are well off their highs. And it's time that companies were forced to pass some of those savings on to the consumer. and the only way that's going to happen is if we buy less. What I say at this area is buy local, buy from the small guys, in your own local area, instead of feeding all of these giant chains. So China's reopening has helped a few countries and brands, shall I say. However, a point here is that it takes time for other sectors to really fill that demand. And the reason for that is because China stockpile a lot of inventory. And until that's being used up at a faster pace, they're not necessarily going to have to go in and replace it. And that can take well over 6 months for that to happen. So let's move on to Europe, and I would say the ECB is going to be split between 25 and 50 basis points at their next meeting. It's going to be interesting to see which way they go. They keep talking about rates need to go higher. And of course, when you look at it, they've only got 3% rates now, after all the hikes that they have done. So any drop in inflation just has to come from lower energy prices. Food inflation is still at those unwarranted levels. So just a reminder, Fed rates at the moment are sort of 4.75%, 5%, Bank of England 4.25%, and ECB 3%. Now, for me, once the central banks stop hiking, then it's going to be a sit and wait situation. I keep mentioning this. For me, it takes time for all these rate hikes to really impact the economy. And although the hikes will eventually dampen demand, for me, it's more about price. It's the price that's deterring the consumers. And of course, whatever happens, don't expect, unless it's another major crisis, another surprise crops up, don't expect all of a sudden that the central banks are going to suddenly start cutting rates, because I really personally do not see that this year. And it's going to be interesting to see when it happens in 2024. I suppose it must happen in 2024, but as I say, there's no guarantee, because these rates are at a point that's probably fair at the moment. Anyway, so that's it for the macro outlook. I hope you've enjoyed it, and please stay with us, because I am now going to do my technical analysis in part 4. And just a little reminder coming up of what we do. So our services, daily newsletters, straight to your inbox, global news, fresh chart levels every day, my views, and then of course on top of that we do workshops, 1-week courses, comprehensive accredited masterclass, trader mentoring. We consult to a variety of companies, and of course we as a one of the leaders, provide lots of trader education to individuals, exchanges and brokers. And if you are underfunded, then just look at our partners website there. They will provide a funded trading account to anyone that qualifies. If you've got any questions whatsoever, contact us at info@cymaxfintech.com, or questions directly for me, chris.tubby@cymax-int.com. If you're in London, I'd love to meet you on Friday. Please come and say hello to me. I am there at the IX Investor Trader exhibition, and I will be attending or presenting all the different aspects of things that they got going on during the day, a round table, doing a presentation, and I'm also part of the expert panel where questions will be fired and we'll be discussing markets. So hope to see you there for that as well. So anyway, now we're going to move on to part 4 with the technical analysis.